Hello, this is an economic, capital markets, and investment update from the Noble Group for the first third of 2025. Much has been happening in the markets, and we wanted to offer some perspective. The last 5 calendar years have been very strong for the U.S. equity markets, with the S&P 500 index, a proxy for the U.S. stock market, up in 4 of the last 5 years, and delivering an average return of about 14.5%, well above the long-term average of 10%. This year, however, things have been a bit more turbulent, with the S&P 500 losing ground after its near-term high of 61.47 on February 19th this year. What ails the market? The key issue is the uncertainty surrounding the tariff negotiations. Markets don't like uncertainty, and this is plain to see. To some extent, we have also seen some compression in the valuations of some high flyers, such as the magnificent stocks like Nvidia. For those of you interested in some more insights on tariffs, I have recorded a video specifically dedicated to that subject. You can find it here at our YouTube channel. The fixed income sector has held up somewhat better, with investment-grade bonds, as measured by the Bloomberg Aggregate Bond Index, up just over 1%. While bonds benefited from a flight to safety, some of those gains were offset by concerns about the inflationary pressure from tariffs. Concerns that foreign investors, mostly central banks, were selling U.S. Treasuries sparked off widespread panic selling in the bond markets, including the municipal markets, which are off over 2% this year. Investors gravitated to cash and short-term investments. When it comes to tariffs and a likely timetable for resolution, no one has the proverbial perfect crystal ball, and markets could move on rumors and social media posts. It is important to have an investment plan and asset allocation appropriate to your situation in life and only make minor adjustments. The French have a saying, plus ça change, plus ça même chose. Translated, the more things change, the more things stay the same. There are 3 key things that drive the markets: earnings growth, valuations, and sentiment. Let's start with sentiment. Investor and consumer sentiment is reaching record lows, almost at levels seen during recessions and the market troughs in 1980 and the global financial crisis in 2008. Inflation-weary consumers are now worried about their retirement nest eggs, and the level of angst seems to line up with people's political views. Sentiment can change on a dime, and investors trying to time the market by moving large sums of money into cash are playing a dangerous game. How about valuations? In our business, we use a number called the price-to-earnings ratio, or the PE ratio, to judge valuation of a company, sector, or the overall market. In simple terms, it's a measure of how much an investor is willing to pay for every dollar in earnings power of a company. In absolute terms, the valuation for the overall market is currently at 20 times next year's earnings. Certainly not cheap in historical terms. However, the Magnificent 7 stocks, which include the likes of Nvidia and Tesla, account for over 35% of the US market and skew that number upwards. Excluding these names, the valuation of the market is about 17 times, not too far away from the long-term average of about 16 times earnings. Valuations have come down quite a bit from the recent peak of 22.5 times earnings, and I see this as a healthy change. Investment success is often governed by paying the right price, and to that extent, prices are much more reasonable now. Earnings growth, often called the lifeblood of the market, is doing okay, despite the uncertainty surrounding tariffs, government policy, and global trade. For the first quarter, the average earnings growth for the S&P 500 companies came in at 12.8%, exceeding expectations of a 7.2% earnings growth. What's more noteworthy is that 72% of the companies reporting earnings beat estimates. With that said, many companies have opted to withhold earnings guidance for the rest of the year, citing policy uncertainties. This has certainly added to investors' anxiety. Companies have battened down the proverbial hatches by stopping new hiring and in some cases trimming staff. Many have held off on capital spending projects till there is more clarity. I believe all of that makes it a great environment for stock picking and one where well-run companies will thrive. Seems lately that the talk of a possible recession has almost become fashionable. But looking at the employment numbers, discretionary spending, the number of people still buying cars and taking vacations, it's just that, talk. If there is a recession, put me down for the not just yet line of thinking. None of us can predict what the markets will do day to day, but history has shown that in the long term, equities generally offer the best returns with low odds of losing money. Asset allocation, for example, by adding bonds to an investor's portfolio, reduces risk, yet without giving up too much return. If you're interested, check out the video on our YouTube channel where I talk about some time-tested strategies and insights on the market. Thank you for listening.